Can you see my slides now?
Yes, we can. Perfect.
Great. Excellent. Great. Okay, so the first slide just talks about us. And we're established by the Nigerian Sovereign Investment Authority in collaboration with Garanco. Today, we're supported by 4 institutions. The KFW Development Bank and Africa Finance Corporation also are providers of capital. We have a AAA local currency rating. Our mandate is to promote long-term financing using our guarantees as credit enhancement to attract investment from domestic pension funds, insurance companies, and other long-term investors. We have strong development partners that have also provided technical assistance support. Now, for InfoCredit, what motivated our establishment was to create a mechanism to mobilize financing from where there is excess to where it is lacking. Importantly, infrastructure plays a very critical role in providing the more needed essential services and promoting long-term economic growth as much as also job creation. And if you look at the structure of the financial market, you'll find a bit of a mismatch in the sense that we have a lack of long-term funding for much needed infrastructure for corporates that need to raise this financing. They tend to borrow mainly from banks, and banks typically have a key constraint in providing long-term financing, given the liability structure of their balance sheet. They also do not provide fixed rate long-term loans because of the constraints of their deposit liabilities as well. And so the actual agents for infrastructure finance will mainly lie with the pension funds. The Nigerian pension fund is currently sized about 10.5 trillion naira. It's growing about 15% per annum. Aside that, you have insurance, but this is a main pool of capital that can be allocated, mainly because, again, you have a contractual maturity of up to 30 years. We have a very youthful population. So the contributors to the scheme, typically, you find that less than, if you look at the demographics in Nigeria, over 50% are less than 30 years old. So you have this long-term capital that can be invested. However, it will only be invested in safe investments because contributors to this scheme expect to be, to get their contributions on retirement. And so safety is critical. Preservation of capital is also very critical. And so our role is to provide comfort to investors. Our guarantees enable access. And I like the point you made that guarantees don't change a bad credit to a good credit. It only enhances access, it improves quality. And ultimately, I would say that guarantees are transitional. Guarantees only are necessary because of a market gap or failure. And so the whole objective is to address the root cause so that ultimately you don't need credit enhancement. The market builds its capacity and the quality of projects become much better. And that ultimately you find that risk sharing evolves into more investors willing to take risks themselves. So we see a huge gap, and that always creates an opportunity. And the way we see this is that in every struggle, there's an opportunity. And the role we play is trying to provide access, which is could be challenging if you look at the sectors. So this slide shows the sectors in which we are able to support. But in every sector, we have eligibility criteria. We want projects that are local currency finance, require local currency to match the revenues, projects that have long-term assets, and I'll talk about that in the next slide. But across these sectors, we support. And I would talk about how, across the sectors, you see how MSME play a very critical role as the underlying economic drivers in these sectors. But how do we support them? Because we can't directly support MSMEs, individually, but the enabling infrastructure is also very critical to reducing the credit risk, bundling, and enabling access. One thing to mention about infrastructure as an asset class, I think is very important to mention, it's typically a resilient asset. And this is because, infrastructure assets are long-term. They typically have, inelastic demand. So if you talk of the toll road, or you talk of power, or you look at telecoms, especially during this pandemic, we've seen the high demand for essential services, healthcare, telecoms, transportation and logistics. So these are essential services that typically, because of the demand structure, the income can be linked, cost reflective. The barriers can be, restrictive depending on the sector in which these assets are being deployed. The cash flows are usually stable, and the economies of scale, it could be large in terms of scale, And over time, with economies of scale, operating costs can actually be lower. So typically, Moody's studies have shown that well-structured infra deals typically have a very much lower probability of default than non-financial corporates, as it were. So it is usually, ideally, a safe asset class. Now, I just want to talk about the constraints that affect most markets, developing markets. And this is not dissimilar from, I would imagine, even your market. So we tend to find that the primary market, which is, and I'll look at it from our perspective and probably a DBN perspective as well, also an NMRC perspective. When we look at institutions that have been established to help promote secondary financing, there is a heavy dependence on an efficient primary market, right? So there's a presumption that the primary market, which is the market where these assets are created, is efficient. And the lenders in the primary market as well are also acting efficiently. Now, the challenge, what we see very increasingly is that the missing primary market intervention requires that we have more risk capital in the form of equity going into developing projects. And everybody talks about the quality of supply. And so for MSMEs, you tend to find that a huge challenge with a major, constraint around governance, the quality, technical quality. So these tend to affect their accessibility. And I think one of the bigger gaps here is ability to invest capital that can go in to take early stage, development support in enabling these institutions to evolve through that early life cycle, so that they're able to meet a lot of these requirements. And so you find that technical assistants are usually deployed to develop the market. The question is there a more holistic way of addressing this gap? Is there capital that can actually play a role in institutionalizing MSMEs, especially those ones that operate in high growth, potentially high growth sectors that require this early stage capital to form the right type of governance, to form the right type of technical capacity to enable them access finance? Because if we're able to solve for the primary market, the secondary market will be much more robust, right? Because what you find is that while there's a significant amount of capital in the bond market, for example, the pension funds, for example, and institutions like ourselves, DBN and NMRC, the intermediation challenge still remains a constraint in the sense of having to actually address market constraints across the value chain. So therefore, you see a growing demand. And we talk about, Amina mentioned the fact that look at the contribution of MSMEs to the economy, but also how many of them actually are accessing finance, and what is the challenge in enabling that access to finance. And so it creates an opportunity, and that opportunity is around how, because you see that the institutions like the pensions want to invest, but it has to be a good asset class. So there is a willingness, and I'll talk about the willingness, but there is obviously rules that apply to how capital can flow, especially from institutional investors. So these obviously, there is a macroeconomic constraint behind all of this, but we need to find creative way of blending capital, technical assistance, and institutional capital to unlock, growth. I've talked a bit about the benefits of credit enhancement. I think we're very familiar with this, and I won't say much because Amina has talked around this already. We all know what the benefits of increased access to finance brings to the economy. Our track record, so we've supported about 4 projects so far, about 31.5 billion, 23 investors, 15 of them have been local pension funds, which demonstrates to you that with good quality assets, good rating, we would attract capital. And this is capital that is about 3.5 trillion, growing at 15%, that is looking for good quality projects. So there is progress that we've made over the past 2.5 years in enabling energy sector companies to raise capital. Now, the broader question for us is, what approach should we look at as we explore how we can support, the core area of the economy, which is the MSMEs? We've considered a cluster approach. We think that through cluster approaches, we're able to reduce credit risk, reduce operating expense, enable better access, and probably we could help aggregate and scale these markets. So we do have a history of clusters being developed, but they're not as operational as they should be. The question for stakeholders is, what role can private sector play in enabling more industrial zones, more free economic zones, because these appear to be a key driver for growth. So for us, we believe that a cluster approach could help unlock access. We're very interested in looking at how industrial parks can be well developed to enable access. You know, these structures actually tend to enable shared infrastructure. And we're looking at a couple of projects in this regard, broadband access and how that enables infrastructure. And I'll talk about what we've done recently. So this is just highlighting, you know, the same sort of regional, the impact when you look at the joined up approach and how these aggregates and mitigate, you know, a lot of the perceived risk we see, it can be addressed in a more holistic way. Now, I'll talk about one project we supported, which is Viatan. So the first company we supported in 2017 was a company called Viatan. Viatan provides off-grid power solutions. Now, we enabled them to raise 10-year financing, which was unprecedented at the time. They were supporting a couple of IPPs to date, which Lagos State was providing offtake, you know, contractual offtake for a lot of their power supply. But they're able to leverage this to raise capital, and with the capital, they were able to increase their operating capacity and also expand, you know, diversify their business. And we could see that there's a lot of development impact in this, but one that interests us particularly was how they supported the Sura market. I don't know how many of you know the Sura market in Lagos. Sura market currently has about 1,091 traders, 700 shops are occupied, and they provide a cluster for SMEs in Lagos Island. Now, what happened was we supported Viatan, and indirectly, they were able to provide up to 1 megawatt of power, dedicated power to Sura market. By doing this, they improved power supply to 1,050 shops, 30% reduction in power cost. This reduced emissions by about 43%, and the shop rental cost increased by 42%. So we see how this impacts on job creation. And for us, it begins to get us more interested in, as we evolve and we look at the next industrial revolution, which is going to be digital, what role could we all be playing in sort of enabling improved access by looking at clusters? So we think, you know, all in all, I think I have 10 minutes and I'll be rounding up shortly. A lot of this will be driven by innovation. We see ourselves as a very innovative institution. We play a lot of our strategy is driven towards creating new products that can enable access. Infrastructure, innovation will create prosperity. The SMEs, we believe by supporting this economic cluster model, we would help unlock access to more financings. I'll stop here, and I'm hoping to discuss more about this in the panel session. Just give me a second. So
thanks, Chino.
Thank you very much. So look forward to listening to my other panelists, and then hopefully we could talk more about the issues and how we can work together to resolve it. So I think Ayodele is next.
Hi, you're on mute.
Thank you, Amina. Thank you very much, Chino, for that brilliant presentation. I'm very excited to be here. Access to finance is a topic that I'm very, very passionate about. And so let me share my slides and show that you can see. So can you see my slide?
Yes, it's perfect.
Okay. All right, so that everyone can focus on my slides. Okay, so access to finance is a topic that I'm very passionate about, and this afternoon, I'm going to be sharing on about 4 distinct areas on how risk sharing facilities helps increase access to finance by not just compensating for insufficient collateral, but also in terms of how it increases single obligor limits, how it increases portfolio limits, and as well as the provisioning and regulatory capital relief that it provides for the commercial banks who leverages the instrument. So going right into sharing the statistics that underscores the funding gap that MSMEs face in their quest to be able to grow their business. I've listed here a plethora of challenges that MSMEs face: finance, finding customers, infrastructure, insufficient cash flow, competition, on skilled labor, technology. And by the way, in the context of COVID today, I know that that ranking of technology is also going to change, but that's a discussion for another day. From this ranking, would all be observed that access to finance account for about 22% of the challenges that MSMEs face in their quest to be able to grow their business. And little wonder that they are only able to access only 5% of the 41.5 million MSMEs that we have in the country can access funding from formal sources. What's the consequence of this? They all resort to informal sources, chief of which is family and friends. So we would begin to wonder that what is it that makes it so difficult for MSMEs to be able to access funding? So we have a high interest rate, you have the collateral issues, and if you observe, I slashed the collateral with guarantees. You have economic conditions amongst several other issues. So you would notice that collateral is the major gap and possibly the single most important cause, which is the lack of tangible collateral. So in the absence of security that might protect against possible default losses, what happens typically is that risk-averting lenders would then refrain from pursuing perfectly feasible transactions. And that's why we see that less than 5% of the MSMEs that we have in the country are able to access funding from formal sources. So the implication of this is that investment that is not undertaken because of this access to finance challenges, it has a social cost. A social cost in terms of output, a social cost in terms of employment forgone. When Amina was giving her intro speech, she did mention that MSMEs account for about 8 out of 10 employment in the country. And yet, this same segment of the market are not able to get funding from formal sources that would help them to be able to grow their business. So in the context of the output and employment generation as a foregone opportunity when credit is not available, we need to understand why providing credit guarantee will be very, very important in the context of MSMEs. I had mentioned earlier on that high interest rate was one of the factors that contributes to funding challenges. The high interest rates that MSMEs typically face is a reflection of how risky that segment is. And as such, it's also the reason why collateral is a requirement for lending. So what is it that makes MSMEs high rates? It's in the very informal nature of how they carry out, how they run their operations, and the fact that they do not have reliable financial records. So now, financial assessment of a business is the most important basis for underwriting decisions for commercial banks. Now, when you now consider the reliability of the information that MSMEs provide, then you will begin to understand that there are limitations. So there'll be limitations in how the lending decision of the underwriting decision of any small business is undertaken. Credit evaluation becomes a challenge. Tangible collateral is required to be able to cover for that gap, which a lot of MSMEs do not have. The type of collateral that MSMEs possess are movable collateral, which has not become mainstream and acceptable to commercial banks in terms of providing funding to MSMEs. There's a limited use of the collateral registry where these movable assets are registered. And I would say today that it's only Access Bank that is currently even actively using this platform. The use of the unique identifier for the movable asset is also not yet a mainstream. Then you will then see that the risk sharing facility becomes a very strong complement that can help increase loan size because it becomes a proxy for collateral and the portfolio limit can be increased. Now, I must mention that there are quite a number of innovative lending methodologies that are being deployed using various risk proxies that would help minimize a finance gap like cash flow lending. But then it's still not it's still not mainstream, or it's not still sufficient to exponentially open up more funding because of the conservative risk appetite of a lot of lenders. So risk sharing facilities therefore becomes a requirement that helps us to be able to close the collateral challenge gap, as well as help to significantly increase the loan amount that a small business can get. Now, in the context of financial access, risk sharing facilities support evaluation, and then it helps provide opportunity for customers who would ordinarily would not have been able to access funding from former sources get funding because the guarantee would then act as a proxy for collateral. So apart from the risk sharing facilities acting as or compensating for insufficient collateral, the banks also have the benefits of getting provisioning relief, as well as getting regulatory capital relief. So if I have to bring this home now in Access Bank, we currently have a product for the healthcare sector. And interestingly, I'm excited that Claire is here because this is also something that we're doing with a firm that Claire belongs to. So the health sector is a perceived high-risk sector, and we have been able to leverage the use of a guarantee instrument to be able to de-risk and help us to deepen lending to this segment. It has helped us to be able to increase our obligor limit. It has helped us to be able to increase our overall global limit of lending to that segment. So currently today, customers are able to access funding up to about 8 million collateral free because we have a guarantee instrument that is helping us to be able to lend. And I also remember very quite vividly that Amina mentioned as well that a guarantee instrument does not make a non-viable transaction to become viable. So we are not, the guarantee instrument in this context is helping us to be able to support businesses that are viable because we have a proxy for collateral. In that same segment, we are also able to lend up to the sum of about 350 million single obligor funding, where even with 50% collateral availability. So all round, we've been able to provide support to a very high risk segment where medical tourism is currently very high, and that's in our own contribution has been able to help impact in terms of a reduction on on medical tourism. It has helped us to be able to support hospitals to become more profitable, and of course more nurses and doctors are getting employed, and in turn those hospitals are able to provide affordable medical care for their patients. So when we connect all of these dots together, the dots between risk sharing facilities and economic development, it's quite simple that risk sharing facilities helps us to be able to increase access to finance. And when there's access to finance, businesses have opportunity to be able to grow. When businesses grow, there's increased output in the economy. With increased output in the economy, then we have opportunities to be able to create more jobs. So overall, there's the economic development in terms of GDP output, in terms of the employment that would have been foregone is sustained and increased. When you also look at the fact that MSMEs are also a source of innovation and technological development, it becomes quite imperative that this is a segment of the economy that we do not want to treat with levity at all. So what does the future of credit guarantees look like? In terms of the volume of the guarantees that we have in the market today and the contribution to the MSME market, it's still quite low when you compare with OECD countries. And then the financing needs for MSMEs is still quite high in the country. So the benefits in terms of the banks who get provisioning and capital, regulatory capital relief, the employment opportunities that it provides, the growth for the MSMEs, and then the GDP outputs. It just underscores the importance of the role that the credit guarantee or the credit guarantee industry plays in the economy. So if you ask me that is there a future for credit guarantees, it is absolutely a resounding yes. It's a future where everybody, all of the stakeholders are playing in that industry. It's a future where everybody wins. So I look forward to having more conversations during the panelist session. So this is what I have for now. Thank you very much, Amina.
Thank you so much, Aya. Up next, we have Ahmed.
Thank you so much, Amina, and a pleasure to be here, and greetings to everybody. I'm connecting through my phone because there's some small glitch, so I'll just ask Wada to share my slides. Yeah, great, thanks. So pleasure to be here, and again, an excellent presentation from Shinwa, who's a good friend, and also I really pleasure to hear from you, and really interesting presentation and slides that you share. So I'll just try to, in my presentation, to take a step back to emphasize why our conversation today matters, and why what Chinua has mentioned about credit guarantees for infrastructure, and we're glad to be collaborating with Infra Credit, and also we have some work that's ongoing with Access Bank, and on top of that, the institutions DBN and MRC that Chinua has mentioned that are promoting sustainable long-term finance in an efficient and in a sizable way that can hopefully help mobilize resources towards development. So why this all matters in today's world and in today's context, and connect the dots, as Adeli just mentioned, along what my colleagues mentioned. So just a quick snapshot on where the global economy is, also to understand quickly, as per our World Bank's latest estimates, where Nigeria stands, Nigerian economy stands. We are today, and part of what we need to do is a realization of where we are today in terms of implications of the COVID-19 on economic activity, and why, as I mentioned again, why the instruments for risk management and for risk mitigation and for de-risking would really matter as we move forward in a post-COVID world. And then we'll have a snapshot on Nigeria's financial sector and where it stands, and some ideas of which risks to share, what to share, and hopefully how. But again, you'll hear a lot of what I'll mention in Alliance, and definitely as we are thinking alike, and I totally believe in what Chinua and Ayodele and other colleagues, and I'm sure also Claire would be mentioning. As we stand today, we are looking at a global economy that is expected to shrink this year only by 4% globally, mostly in advanced economies impacted and affected by the lockdown due to the epidemic outbreak, and a bit less of a contraction in the emerging economies that were more diversified and also that were not strict in terms of lockdown as the advanced ones. And accordingly, it's an overall contraction of 4%. Which would require all the focus next year on recovery, and hopefully as solutions to the health crisis would prevail. Then I think the focus will be on recovery, and part of that is focusing on de-risking. As we stand now, the financing needs, and that's on the right-hand side of my slide here, the financing needs are growing in sub-Saharan Africa. Nevertheless, also the cost of financing is increasing, and accordingly, and that's at the sovereign level. So needless to say that on the domestic level, when it comes to the domestic economy and the private sector financing, instruments for de-risking would really play a critical role, as you heard from my colleagues earlier. So if we move to the next slide, so Wada, can we please move ahead? Yeah, great. So in Nigeria, I mean, unfortunately, we are expecting a severe contraction for 2020. Hopefully, it does not stay as long. So we're expecting around 3 to 4%. However, we are hopeful for what they call, and what you hear in the global economic news as what they call the V recovery. So the V-shaped recovery would hopefully means that in the aftermath of the crisis, we hope that the recovery will be strong, will be quick, and that would definitely be a function of what policies will be in place to ensure that, and what instruments for risk management and regaining back momentum for growth would be. And again, this is part of reinforcing why my colleagues' presentations and what today's discussion really matters. So in the next slide.
Carry successful.
In the next slide, again, the slowdown in the economy is affected by several factors, including not only the health crisis and the pandemic crisis, but we need to also be mindful that there are challenges when it comes to the oil prices, which makes it a bit more stringent in terms of the slowdown, and also makes it really critical as we think about recovery into instruments that would help with dealing with the uncertainty of the future and also mitigate possible risks for the future. Next. Yeah, and as part of why credit guarantees matter and why we should be supporting micro and small enterprises, and on top of what Ayadali mentioned, I think we need to understand also that as part of the first round effects of the pandemic, and based on a recent World Bank survey for April and May, we are envisaging that there is a huge impact for the COVID-19 on employment, and accordingly and particularly the hit is affecting the micro and small enterprises, and these are the ones who not only the engines of growth, but this is the segment of the economy that would merit support as we move forward. And the credit guarantees and the discussion that we're having today is really relevant when it comes to supporting the micro small enterprises to recover and to offer jobs and getting back to the right track for growth. Next, please. As we talk about credit guarantees and as we talk about financial intermediation and getting the financial sector to intermediate in an uncertain environment, it's critical to understand also what are the factors that would influence intermediation, because this will help us understand and identify the risks that faces financial intermediation and that faces the banks and financial institutions when it comes to credit allocation. And it also will help us to identify how to mitigate and manage these risks and how the credit guarantees and the risk-sharing instruments would matter. And as part of that, what we usually in the literature, the exchange rates is part of that. The capital flows to the country is part of that, and also the internal dynamics of the economy and the implications of the lockdown and the implications of the slowdown on the economy as prices surge a bit in response to the COVID-19. So in a nutshell, the financial intermediation and the decision to intermediate funds and the risks that would underlie the financing decision would necessarily need more instruments to mitigate risks and to help manage risks. So we move forward then. So financial in the next slide. Yes. In the next slide, what we're realizing from the leading indicators of the initial data that's coming out with regards to the Nigerian financial sector is that the lockdown have implicated financial intermediation severely, particularly to the private sector, with a drop of 65% in April, definitely partly driven by the lockdown and implication of the lockdown and halting the economic activity. And we're hopeful that this will rebound as the limitation of movement and as the lockdown measures are abolished. But that have also is an alerting signal for us to understand what are the risks that are underlying credit decisions, and also how can we, in the immediate term, mitigate and help the financial institutions to mitigate these risks and pay more attention and focus into financing the real sector and gain back the trust and deal with the uncertainty that the pandemic is leaving on the economy. And that include the pandemic outbreak risk, interest rate risk as part of possible responses to inflationary pressures or decline on capital flows, and the oil price shock and the exchange rate shock that is implicated by the pressures that we are envisaging on the exchange rate. So these combined factors and these combined risks definitely play a critical role when it comes to assessing credit risks and when getting the financial institutions and the banks to reconsider intermediation in the post-COVID world. So as we move forward then, so what is to share here? So the critical issue or the critical risk to share here, and as we move ahead to hopefully gaining the recovery momentum and supporting micro and small enterprises again, and getting banks more comfortable to engage in risk-taking behavior, is to try to share the credit risk and create a more or a stronger buffer and cushion to enable banks to get back to the lending business and to get back to supporting the real sector and particularly the micro and small enterprises, and ideas going around scaling up coverage when it comes to loans that originate post the COVID-19. And also, as Adali might have emphasized, is the volume also of coverage would matter as we envisage recovery. And it's indeed instruments for risk sharing and credit guarantees would help alleviating constraints that face various micro and small enterprises as the banks consider risky taking decisions on risk allocation and on credit allocation. So moving forward. So as my colleagues and as Mina might have elaborated in her introduction, and also Shino and Aydali have mentioned, and it's always good to come last because colleagues would share good ideas ahead of you, so it makes the presentation shorter, but hopefully we'll interact more as we move forward. But it's really critical as we scale up credit guarantees is the how. So the how is that considers smart decisions, and I think DBN is also through Impact is playing an important role in moving forward on this, is identify what target groups are there, is identify the missions and objectives, and identify the volume, again, as Aydali mentioned. How to smartly mitigate moral hazard and ensure the quality of assets and ensure the quality of loans. I mean, the credit guarantee, as my colleagues have mentioned earlier, the credit guarantee would not turn an inviable SME to a viable one. The credit guarantee would help a viable SME that has been suffering to access finance to hopefully access it comfortably through a third-party guarantee that is provided there. So the value proposition that the credit guarantees offer, it helps identifying the market parameters. It is identified through aligning commercial objectives with the development objectives to support the engines for growth and job creation in the economy, which are a bit riskier. We need to also consider that, yes, incentives are good, but we don't want incentives to be deterrent towards sustainability. And hopefully the credit guarantees the credit guarantee instruments and risk sharing instruments would provide a win-win situation for everybody, for the credit guarantee facility, for the financial institutions, and for the beneficiaries. I know I'm running out. I'll try to be brief yet. As we create the ecosystem, I'll be glad to interact more on this slide as we move forward. It's critical to create the ecosystem to understand how would we share the credit risk. Remember, we said what risk do we share and how. And so this is the how. The how is about defining the eligibility criteria, identifying the delivery model, whether it will be individual or portfolio approach or a blanket guarantee approach, the segmentation of the products across financial institutions and also across instruments. The level of coverage will be needed, and I'll be sharing very shortly that the coverage has gone from an average of 70% globally, between 50 to 70%, all the way to 100% in the post-COVID world, which then takes and pushes the frontier for credit guarantee facilities during recovery to play a critical role. But also, is this ecosystem that we're seeing right now is really critical when we create it and we set it up to ensure the sustainability of these vehicles. Pricing is really critical. The ownership and aligning mixed ownership or private ownership, hopefully, as it becomes more efficient and standalone, and it can sustain on itself the facility. I mean, the credit guarantee facility. What Chinua mentioned on technical assistance is really critical to build capacity and provide technical assistance to the financial institutions and also to the beneficiaries to enhance their credit viability. And I know a lot of banks in Nigeria are offering interesting programs to enhance entrepreneurship. Lastly, but not least, is the regulatory incentive and how to recognize these guarantees. And I think also already is mentioned to that is that identifying how the guarantees can help when it comes to identifying regulatory capital and identifying the risk weights for risk assets. We'll move next. Yeah, so in the post-COVID world, in the advanced economies in Western Europe, there has been strong reliance on credit guarantee schemes to finance micro and small enterprises towards recovery and to enhance and to expedite recovery. And I just mentioned a minute ago that the coverage is going all the way through to 100% for loans for micro and small enterprises in the post-COVID world. But as we move forward here, we need to be very careful about whose this coverage is granted to. It's not granted to everybody. There are tough decisions definitely that will have to be done at the financial intermediary level, financial institutions level, namely banks, and also at the guarantee fund level when it comes to identifying who should be targeted with the scaled up and similar programs as I'm sharing right now. And here the focus is usually on the viable firms, and the viable firms are the ones who are able to sustain, who are able to stand resilient in the face of the recent shock, but would hopefully, with a bit of support and with a bit of help, would drive recovery as we move forward. Other more implicated micro and small enterprises can be subject to other programs. Rather, the sustainable programs and the sustainable instruments as risk sharing should focus immediately on viable firms as we move forward to expedite recovery. Last but not least, I know I might have gone beyond my 10 minutes, so apologies. Yeah, so moving ahead to the next slide. As I look forward to that discussion, and I think there are a number of considerations that we need to keep in mind, where particularly when it comes to partial credit guarantees to small and medium enterprises. One is the regulatory forbearance and implications on asset quality, because the asset quality is really critical for the credit guarantee schemes to sustain. Regulatory incentives that I just mentioned, and Aliodi also mentioned, how to recognize these guarantees when it comes to risk weight calculation and providing risk relief and enhancing liquidity for banks as an incentive to underwrite more loans and underwrite more risk. The currency denomination of the guarantee facility is really critical, and I think with all the uncertainties, not necessarily in Nigeria only, but all around the world now, I think the local currency instruments would be more viable and more feasible now as we drive recovery to mitigate uncertainties around exchange rate and around exchange rate risks. One critical element for the credit guarantees ecosystem to function is the non-performing loan resolution and contract enforcement, particularly when it comes to asset seizure, repossession, and resale. And that's really critical because that's the only way a credit guarantee facility would survive when it comes to calling upon loans and then calling upon collaterals. And I know that colleagues have alluded to cash flow lending, which is really interesting, and that would go through a different round when it comes to risk assessment. Expanding credit informational base is really critical, and that relates to the cash flow lending point that my colleagues have mentioned. If we rely and provide guarantees for cash flow financing, it's really critical to deepen the informational base for credit decisions. Lastly, but not least, and I hope I will not be punished for extending beyond my 10 minutes, balancing the risk, the coverage, and sustainability and the pricing is really critical as we move forward, especially with all the supporting schemes that are showing up. As I just mentioned, even in advanced economies where 100% coverage and subsidized pricing. As we move toward more sustainability and through the route of recovery, it's really critical to keep the eye on the ball to enhance sustainability of credit guarantees and balance the risk and sustainability. Thank you so much. I'll stop here, and I hope everybody stays safe and stays home. And if anybody goes out, please wear a mask to protect lives. Thank you.
Thank you, Ahmed. Okay, up next we have Mrs. Claire Omasher. She's the MD of GNC International. She's also a director at the Development Bank of Nigeria. Okay, hi, thank you.
Hi, Amina, and hello, everybody. Just let me get my slides up. So good afternoon, everybody. It's great to be here today, and thank you for the invitation. For me, I guess as the last speaker, a lot of what I'm going to say has been said, but most importantly, I'm going to bring the perspective of the MSME, having been there before. As you said, in addition to the fact that I'm an independent director of the Development Bank of Nigeria, 15 years ago, I grew a company called JNC International, which has grown from an entrepreneurial venture today to being a national corporate and slowly getting into a multinational. And this couldn't have been done without access to finance. But this is not the same story for a majority of MSMEs across Nigeria, Sub-Saharan Africa, and indeed the entire globe. And as my colleagues have already said, MSMEs are actually the largest employer of labor in our country. And where we have job creation as a big challenge, and where we have economic viability, especially during COVID and post-COVID as a challenge, we have to think of innovative ways to continue to keep this sector, the MSMEs, viable. They are the foundation and the building blocks of our economy, and they're the drivers of the industrialization that we require to take our country to the next level. And it is because of the value creation that they create on the different value chain. I mean, we have a completely diverse number of people that do different things, from products to services, from entertainment to pharmaceuticals, you know, from hotels and hospitality, all the way down to production of simple things as masks. So it's such a vast and wide scope when we talk about MSMEs. But at the end of the day, they contribute about 48% of our GDP. And yet the challenge, as we've heard all speakers speak so far, is that access to finance is a big issue, with less than 5% of MMCs actually getting access to finance. And this is, first, speaking from my own opinion, is that the first thing that any entrepreneur has is the passion. Passion to make a difference, a passion to do something. Unfortunately, passion is not bankable. So the challenge we have is that the entrepreneur doesn't understand banking, and sometimes the banking sector doesn't understand entrepreneurship. So the bridge building we're doing today, and which developmental banks are doing and the World Bank is doing to build that bridge between the MSMEs and the commercial banks, is what is going to make that difference. And I think this seminar today is a great bridge builder. You see a lot of businesses that are therefore grown from an informal source of revenue, either family, friends, sometimes they say it's another F, which I won't mention right now, or by spontaneous financing, where you're able to get finance from some of your suppliers. But the big issue is that this is a limited part of the market. And therefore we need access to the more formal part of the market, which is more structured, which is the commercial banks and developmental finance institutions. Again, the challenge there is that, of course, pricing is done by risk-based issues. And when we see the risks that are associated with MSMEs, you find that a lot of the MSMEs are not able to be bankable by the commercial banks. And this is really because of poor corporate governance, poor bookkeeping, as we've seen earlier, just that lack of risk mitigation that is important. And therefore, my challenge I see in Nigeria is the lack of transgenerational businesses. There are very few businesses that have transcended one generation to another. And this is something that we all need to look at, and I really would like to talk about it maybe in the discussions. And therefore, you can see that the Nigerian government and many governments across the world have now started paying a lot of attention to MSMEs, as well as the regulator, the central bank, and developmental financial institutions like the Development Bank of Nigeria. And this is to think of innovative ways in which we can find more affordable long-term access of capital, be it through debt, through equity, and as we'll see today, through credit guarantees. And we cannot ignore that 90% of all the non-white collar jobs, if we don't look after them, we will have a challenge. Now, if I look through the things that affect, the biggest challenges that affect access to finance, my colleagues have said it, so I will not spend too much time about it. But the first issue is that it is affordability. Paying anything between 24 to 48%, sometimes up to above 60, is really not accessible to the average entrepreneur. The second thing is that there's a lot of paperwork. And as I said, people have not had formal business training, and therefore don't know what a P&L is, don't know a balance sheet, have never calculated a beta or return on investment. And therefore we're all speaking different languages, and it's important that we close that gap. Also, the lack of accountability and financial records. People a lot of MSMEs tend to keep several books or no books in that case. And therefore there's no differentiation between owner and kitty. And this is something that needs to be sorted out, but this is a challenge which commercial banks easily say I can't bank this sector. In fact, there are certain banks in Nigeria that will not bank SMEs. And this is something that we need to change. The other issue, of course, as my colleagues have already said, is the issue with shortage of equity, the initial equity, or in this case, collateral. The kind of collateral that is being asked by banks is substantive and sometimes up to 100 to 150% more than what they have. And finally, the issue to do with risks. Now, these have been mentioned already by my colleague from Access Bank, so I won't go there. But it really is unsustainable to try and grow a business that is a long-term investment with short-term funds. And when you do that, it's a disaster waiting to happen. And that's why you see that almost 90% of MSMEs die before their first birthday. So we need to have access to long-term capital. That's the first thing. Secondly is the fact that the interest rate is very high. And the third part, which is what we are talking about today, is this issue of collateral. You see that some banks want 120%, 150%. The quality and the quantity of the collateral is very important. I know that we have two other options now in Nigeria, which is fantastic, with the movable asset register. But as you heard, a lot of people are not really taking advantage of that because, again, the quality of that asset is not always tangible, and therefore it's still small. Then banks also reduce or limit the amount of movable assets that they can take as collateral. So it just shows that we must be innovative, think out of the box, and do things differently. If I just zoom in on COVID right now, COVID has even made the situation for the average MSME worse. A lot of MSMEs in the last couple of months have folded up or they've exhausted all their retained earnings. And this has made it almost impossible. It was one thing, they were already in a hole, but now they have to dig themselves out of a hole to be able to look for how to look after those contracted, or in this case, collapsed cash flows. And therefore, what we're going to talk about, credit guarantees, is one of those key drivers that could actually help to reduce some of the challenges of credit risk with getting people out of the post-COVID issues. And we need to be able to provide those things. Now, what do we mean by the credit guarantee? We've heard exactly what it is. Very simply, for the MSMEs in the room, I know we've been speaking very highfalutin and some of the grammar you don't understand. So I will try and break it down a little bit. So it simply means that a third party is giving a guarantee to another bank who is giving you the money, should in case you don't pay back. That does not mean that you should not pay back. So it is not going to look at the viability of the project that is being financed. It's just going to reduce the risk to the bank who is going to provide you the funding, so that either your interest rates go down or the collateral requirements that we require also go down. And this is something different. This is something innovative. And we've heard that this is happening in infrastructure, it's happening in agriculture, but now it's coming to the MSME sector, which we need to better understand. And this is now a special purpose vehicle that can reduce those losses to anybody who is now providing that third party, that financing to you. I put it in a different way. For every time a loan goes bad, what we call a non-performing loan, it is against, it marks a brownie point against the MSMEs. So whatever we can do to change that narrative and get more MSMEs bankable, it would be great. And I use an example of what my colleague in Access Bank said. We've worked with the different auspices. I also am the president of the Healthcare Federation of Nigeria, and we've worked with a risk guarantee company, which is offshore, and they provided a partial risk guarantee to the pharmaceutical sector. The loan payback, there are no NPLs in that entire portfolio, and the payback is 99.7%. And if I may say so, 100% for women. So women businesses are even more trustworthy. But it just shows that it is possible that if you provide a partial risk guarantee through a credit guarantee scheme, that you can change a vicious cycle, which is not allowing a lot of MSMEs to get access to finance, to a virtuous cycle where we have more people that are now being able to contribute to the economy, create jobs, and make an impact and make that change that is required. When we think about the benefits of this risk sharing, they are different for the MSMEs than from the government. Just to highlight a few, it will eliminate the financial oppression that sometimes we see with different kinds of pricing that are very predatory. It also helps with sharing the risks and making sure that that wealth is more equitable. With government, it helps to look at all those macroeconomic objectives that we need to be able to fulfill, from job creation, resource allocation, robust growth, and wealth distribution. So there's a lot of benefits that leveraging on risk sharing can bring. I thought I'd share a couple of slides just to share my own experience. So JNC International is a proudly Nigerian company. We're 15 years old. We started as an entrepreneurial venture of 4 people. We couldn't afford to have highfalutin managers. We didn't have the structure, but we knew we wanted quality, and we put governance in place from day one. Governance is something that is missing in a lot of SMEs, and this is having a board so that you are not, even if you're owner managed, you are not totally putting your hands in the till and doing things that you shouldn't do. We've grown from 4 people now to 105 people, and are proud to say that we are one of the major medical equipment solution partners across Nigeria. We represent 21 major manufacturers. So imagine that we started as an entrepreneurial venture of 1 person, then 4, and now 105, and now we represent 21 major manufacturers. So if we can do it, you can do it. And this can only be done by using and leveraging innovation. These are some of the products that we do. And again, just to show you the profile, we've gone from that entrepreneurial venture where we used informal financing and spontaneous financing, which is our clients would give us money and we would use the client's money to grow ourselves. Then we moved on to a national corporate where we used our retained earnings, so we continue to turn over our retained earnings and also borrow from commercial banks, to now where we're no longer, of course, we still have to borrow money ourselves from commercial banks, but we're now looking for innovative financing solutions for our clients, including using risk guarantees. So we have partial risk guarantees to help reduce the collateral requirements for our clients. And we have various options, and we're working with commercial banks and developmental financial institutions to co-develop these. So the charge to those of us that are MSMEs in this room is the fact that these credit guarantees enhance access and improves the quality of your credit and closes the gap that exists in the market. If 95% of the market doesn't have access to capital, doesn't have access to finance, we could slowly, using credit guarantees, close that gap. It won't be overnight, but it's a gradual process. And having more of the credit guarantee companies in Nigeria, as we will hear about in the conversations, it will play a major catalytic role to the economy and to our businesses. It will reduce the collateral requirements that you need to take to your banks and provide a strong buffer for us to now have a better way of doing business in Nigeria, making it more easy. With credit guarantees, it provides those banks that we work with more comfort by providing that risk guarantee. And most importantly, it's a much better alternative solution for credit-worthy firms. There's so many people with great ideas, even with COVID. Lots of technology firms, mask-making firms, and all they need with their great ideas and their passion is to be able to take that to a bank, find an alternative way of making sure that they can get out of the contraction, stabilize their cash flows, and leverage on some of that innovation. And finally, what are the asks from MSMEs to credit guarantee companies? One is, from the little research we've done, is the fact that we need a lot more communication on what is the application process. How does this go about? Are the MSMEs to go to the credit guarantee companies? Are they to approach the commercial banks to get the credit guarantee? There's a little bit of gray area here, and there's more, people would like more information on that. The second is the importance of capacity building and sensitization. So a lot more beyond this webinar needs to be made to create that enabling environment for people to understand better credit guarantees and how they work. And then others have expressed a concern that when they get a credit guarantee, would they have to pay more money because they are adding somebody else is paying, there's a third party adding that guarantee on. So the question is, please don't add any more money or don't increase the cost of the loan because of the guarantee. So this is, I'm sure, a topic that we'll discuss today. But I mean, and finally, is the role of the financial regulators that our regulator, central bank, could also consider providing a counter guarantee to the credit guarantee companies to be able to reduce credit risk, to deepen the funding market and make it more easy for the average MSME and the large corporates to access finance. Thank you very much.
Thank you so much, Claire. That was a fantastic presentation. And thank you for breaking down the conversation. That was very helpful. So we've heard from Claire, last but not the least of our panelists. Also, we heard from Chinua. Chinua aptly described and demonstrated how InfraCredit has aided access to long-term finance for various infrastructure projects and multiple energy companies. He's also demonstrated how this access has created jobs and, of course, provided funding that would have been less likely to achieve. Also, we listened to Ayo. Ayo gave us very practical description of how credit guarantee was used in her business to unlock funding for the healthcare sector, resulting in more affordable care, as well as creating jobs. Also, she showed us how credit guarantee has been used to provide funding for businesses that would require collateral. So, of course, providing access and also increasing the overall quantity of funding that is available to the small businesses. Thank you for that. We listened to Ahmed as well. Ahmed spoke a lot about the role of credit guarantee and importance of credit guarantees post-COVID-19. And of course, Claire spoke very passionately about some of the challenges faced by MSMEs and the need to identify, and of course, that's the whole purpose of this discussion today, the need to identify more innovative ways to unlock this funding, and which is why we're having this conversation, like I said already. We will continue to have these kind of conversations. And of course, the questions that came at the end were very, very critical. The questions, as she mentioned, what are the asks of the MSMEs? So first of all, she talked about what's the application process. Of course, different credit guarantee institutions apply different models. But typically what happens is, as a business, you go to your bank to seek funding. The bank determines, based on the information that is available about you as a customer, whether or not to provide the funding that is required. And then the bank decides whether there is need to use a credit guarantee to enhance that particular loan or not. So we don't work directly with MSMEs, which is why, of course, there seems to be a gap with respect to communication. Also, Claire, I missed one of the questions actually. Are you able to please put that up for a minute? I think it's important we address those. Okay, thank you. Yes, in terms of the additional costs, of course, like I mentioned already, because you work through your financial institution, it varies, right? In the case of, what Chinua described in terms of providing access to untapped capital for, let's say, Viathan, this would have been funding that would have been otherwise difficult to achieve. So in terms of what the cost would have been, that's also quite difficult to place in some cases. What I can say though is that there are cases where the credit guarantee, could increase the cost of funding, but there are also many cases where it reduces the overall cost of funding. So this tends to vary by the request. Capacity building, of course, is one of the areas that we, typically work on. Capacity building, of course, is also provided through the Development Bank of Nigeria Group, through different educational sessions, and of course, putting out a lot of educational material every now and then. The regulators are active, the regulators are aware, and the regulators also continue to set up credit guarantee institutions in this part of the world as well as other parts of the world. We have some questions aimed at our panelists. I'll just quickly go over those. So Chinua, the first question is for you. It's from Said Yemi Awojide. He's asking, what are the requirements for MSMEs to get credit guarantee from InfraCredit?
Thank you. Can you hear me?
Yes, we can.
Okay. Well, I mean, unfortunately, we don't deal directly with MSMEs because of the size. Infrastructure typically is scale. So we will support larger scale corporates that are providing essential services across energy, transport, telecoms, waste. So these are the sort of institutions we support. And in my slides, I did talk about how we are, how we view MSME support indirectly, because these companies provide the essential services that support the MSMEs in their operations. So you see how the example of Batam providing power to a cluster, and within that cluster, you have MSMEs there, reducing the cost of power by over 40% and increasing the employment rates, because it creates a more efficient enabling environment for them. So the way we work is supporting enabling infrastructure. And also we're very interested in understanding how industrial parks, knowledge parks, and similar sort of clusters can be supported to bring in SMEs to co-locate, reduce their costs, and create more efficiencies and economies of scale. So that's the approach we look at MSMEs from.
Okay, thanks for that. The next question is for you as well, Chinua. We have Noah Oladoja. He's asking for Technology Incubation Center, which is a cluster of innovative entrepreneurs who add values to agri raw materials, fabricators, etc. How can we key into your clustered approach in Ekiti State?
Oh, well, I didn't talk about Ekiti. Well, but I think it is the collective approach. For us, it's really an idea we're thinking about, and it has to be something we look at with other stakeholders. Everyone has a role to play in sort of thinking creatively, particularly when we look at institutions like the DBN and how this probably enables more access to finance for SMEs. We look at the government themselves. So government has a role to play in providing, either the access to land and other enabling infrastructure. So we think that if we can work collaboratively with key stakeholders, it is very possible to sort of support these sort of initiatives in creative ways that can work. I'm aware that in Lagos, for example, there is a move to relocate, for example, the computer village. Now, these sort of clusters can be supported in a way that creates sustained growth. And it's something we're certainly interested in, but I'd say we're working with other stakeholders to figure out the best solution that can make this work.
Okay, thanks for that. The next question is for Ahmed from Boyega Olorunfemi. Says it appears that we're doing way below other nations on the side of financing for renewable energy. How best can this be driven to create more social impact?
Well, thank you. Well, I think the renewable energy itself is an opportunity particularly for small and medium enterprises, as Chinua mentioned, either for acquiring a more efficient source and sustainable source for power, but nevertheless also for innovations when it comes to how to create clusters and how to approach this in a sustainable manner. I'm not sure about whether doing better or worse, that was part of the question compared to others, but what I'm sure of is that there is an opportunity when it comes to renewable energy, and as I think part of the thinking in the post-COVID support is how we can work on supporting and financing small and medium enterprises that would rely on more sustainable sources of energy, including these generated from renewable means, and for sustainable means, I mean, to solar panels and solar energy, particularly in Nigeria. That's a big opportunity. So how to support them and how to scale this up in a sustainable manner. I've seen a couple of innovative projects that are working on this with the clustering approach, and I think this can definitely be an untapped opportunity and a possible opportunity for micro and small enterprises to scale. Thanks.
Thank you. Okay, Larry Bakri was asking, will credit guarantees be available to finance companies in Nigeria anytime soon? The answer to this is yes. Credit guarantees are available to, credit guarantee companies are able to work with finance companies. So it would be good for you to reach out to an appropriate one to take this conversation further. For Ayo, do you expect an increase in popularity of credit guarantees in the near future? And would you use credit guarantees to dampen the impact of COVID-19 on your portfolio? So by this, what we're asking is, of course, COVID-19 has resulted in a reduced, in less disbursements, essentially. Would you use credit guarantees to continue to facilitate lending in your bank?
Okay, thank you very much, Amina. Yeah, the response to that is yes, credit guarantees and instruments that we're already using to be able to enhance lending, like I had talked about earlier on. Even in the context of COVID, it's one of the reasons why we never actually slowed down on lending, even to that particular segment of the market. It never even came under the radar of segments that we should slow down lending on. Access Bank continued to provide lending to prioritized segment, and even for the non-prioritized segment, as long as we're able to see that you have been able to make changes that would increase the scope of your business to be able to be able to impact of COVID, we did not necessarily stop lending. But I dare say that especially in the context that Ahmed has described, the fact that COVID has, or generally, yes, lending has slowed down. Having a credit guarantee would have helped us to really, a lot of organizations to continue to sustain lending to MSMEs, especially where there's a justification for the fact that there's this business is still a very viable one, notwithstanding that. So it gives us more confidence to be able to grant loans, and not just for the organization to just shut down and not support the MSMEs.
Thank you for that. Hi Claire. Would like to understand how you achieved 0 NPL for your healthcare cluster. I mean, apart from what you had mentioned about women being quicker to pay back.
Okay, I think this is more directed at Ayo, but so as the Healthcare Federation,
I was actually going to say that should be my question, but it's okay. Claire, go on.
I will start and I will hand over to you, Ayo. I mean, the starting point is what I think is that professionals have organized themselves to speak with one voice. So you have the Association of Community Practice Pharmacists, you have the Healthcare Federation of Nigeria. So when a banking entity wants to deal, they're not dealing with one individually, they're dealing with a group. And that was the starting point. And then again, communication, a lot of communication between Diamond Bank, now Access Bank, with them. And then Medical Credit Fund actually was the, will I say, the risk sharing, credit partial risk guarantee foundation that provided the money, or provided the guarantee, sorry. And then for the communication started, it was very clear. There was a single obligor limit. Everybody knew, the terms and conditions. And because you're part of a group of people that all were enforced at the same time, I think working again with a partner, the bank understood MSMEs. And that for me was, I think, a real rate limiting step, a key success factor. The bank had gone out of their ways to bank MSMEs. It's not just I want to do it to tick a box, but they had this as part of their ethos, part of the vision and the strategy for the year. And I think for me, those were the success factors. Then of course, the industry itself, pharmacists, industry, remember they're buying mostly inventory for their pharmacies. And this is very high turnover, capital intensive, but they need to have the working capital. So it was a working capital arrangement. And I mean, honestly, we call ourselves men of honor as pharmacists. And I think everybody was honorable and kept to that level. There was only one slight default, and even then that hiccup was corrected as we went along. But I'll allow Ayo really to answer this question. You should take the glory.
Thank you very much, Claire. So we've had a very, very effective and wonderful partnership working with Medical Credit Fund. And Claire As she has described, she's been very instrumental to the success of that initiative. So I would say that, yes, that particular portfolio, what we've been able to achieve is 99% of our performing loan. And to what Claire said, we had very few, a couple of businesses that had issues, but then they were not issues that bordered on integrity at all. They were just issues that bordered on some operational issues that were able to correct. And working with the Health Association, which Claire is a member, it was quite helpful, and every day our confidence grew in being able to engage and provide funding to that segment. So it was a couple of things. The way the program is structured is a bundle, is bundled with capacity, a technical assistance program where the firm, they go and conduct due diligence on the health care facilities. One of the benefits of that due diligence is the fact that it helps these businesses, helps them to be able to run their hospitals as a business. So there's a tendency for you as a professional or as a healthcare practitioner to want to specialize. Okay, I'm a doctor and all I want to do is to be able to take care of, to specialize in gynae and take care of pregnant women. But that does not necessarily mean that your operation would be successful as a business. So one of the benefit of the technical assistance program is that they help them to be able to balance the business, incorporating money leaders and money-making activities that helps you to be able to run profitably as a business. So first of all, yes, you're there to be able to help save life, but you also must structure your business and run as a business. And then so when you begin to do that, then it becomes very easy for us to now come in and say, we want to give you loans. So the Medical Credit Fund helped in that aspect of providing that technical assistance before those applications will now be forwarded to us. And then we now apply our own risk acceptance criteria before we are to now grant loans to those to the customers. So that combination has helped. It's our best performing portfolio in emerging businesses. In the best performing 99%. We don't even think about it. As long as we follow the end-to-end process that we have put in place, everything is fine. I remember now that you had also asked me about the popularity of credit instruments in the future. So there are a lot of the credit guarantee, the way now we're actively seeking partnerships to be able to help with the provision of credit guarantees, and in doing so, there are a lot of creativity around how you structure them. It's not a one-size-fits-all. So it all depends on what it is that you want to achieve in the day. So, when you, from the experience that we've had on the existing portfolio, I have become a very strong advocate of looking out for credit guarantee instruments to be able to support the portfolio or support lending activities to MSMEs. Even when Claire was making her presentation, she did mention that some banks will not even touch MSMEs. And that's just because of the very high risk factor of, that makes up which is inherent in the segment as a whole. But then when you begin to have support in terms of instrument, the credit guarantee instrument, all of the other proxies coming together, I think the future, like I mentioned in my presentation, that the future is very bright. So I see that the credit instrument is going to really become very popular in future. Thank you.
Thank you for that, Ayo. I have to apologize at this point. There's so many questions, and unfortunately, we don't have enough time to take all of them. I'll take one last question just before we wrap up. This is from Shegun Martins Uguyemi. He's asking that, as good as it sounds, I believe credit guarantee schemes will come with an attendant cost for the SMEs. So my question is, how do we mitigate these additional costs or charges as a result of third-party involvement in accessing credit and loans? Chino had addressed this in his presentation to a good extent. The whole point is credit guarantee to a particular sector or to a particular segment is not meant to be permanent. It's to encourage participating institutions to go into the segment, come to understand and be able to differentiate good borrowers from bad borrowers, And then over time, what happens is you have better experience and better knowledge of the respective segment or with the respective sector, and you're able to differentiate customers. And over time, you see that the cost is actually going to go down. When we talk about a customer as well who would ordinarily not have had access to the funding due to lack of collateral, of course, by the time you consider the cost of, the acquiring collateral, the cost of legal and administrative procedures, you find that, of course, the credit guarantee cost doesn't significantly increase compared to what the cost would have ordinarily been. So thank you everyone for listening. Thank you for your time. And we look forward to you joining the next webinar. The next webinar in the DBN, please visit devbankng.com. That's www.devbankng.com for details on the next webinar, which would be updated on the website soon. Thank you so much. Any questions, please send to info@devbankng.com. Thank you, everyone. It's been a wonderful session. Thank you for our wonderful panelists as well. We appreciate your time and we look forward to seeing you again soon.
Thank you.
Thank you so much. Stay well. Thanks. Bye.
Thanks. Bye.
Bye.
See you.